Most traders watched Bitcoin surge with massive volume and screamed, "BUY!" But the wise trader paused. Something was wrong. That enormous effort produced almost no price advance. The market was shouting its secret, not through movement, but through its absence. When volume roars yet price barely whispers, the professionals are quietly positioned against you. Volume is the effort. Price is the result. When they diverge, the trend is already dying. Now you know how to read it. Develop the ability to correctly interpret price action with respect to its volume. This is what separates the informed trader from the crowd. The market never lies, but it will test whether you're listening. Every single day, thousands of traders sit before their screens, watching candles form, watching price move, and they lose money. Not because the market deceived them, but because they were only watching half the story. They tracked where price went. They never once asked how much effort it took to get there. That single blind spot has quietly destroyed more trading accounts than any strategy failure ever could. Stop. Before you execute your next trade, ask yourself one honest question. When price moved in your favor yesterday, did you verify whether the volume supported that move? Or did you simply see a rising candle and call it opportunity? Most modern traders using sophisticated platforms, algorithmic alerts and real-time data feeds are still making the most primitive mistake possible. They are judging a battle solely by its outcome, never by the force required to produce it. A general who wins a battle at enormous cost is not in the same position as one who wins effortlessly. The market operates by this exact same logic. In my decades of studying the tape, one truth became undeniable. The market is a living record of effort meeting result. Volume is the effort. Every contract traded, every order executed, every institutional position opened or closed, that is effort made visible. Price is simply the result of that effort. Nothing more. When a large professional operator wishes to move price upward, he must deploy significant buying power, significant effort, to absorb every sell order standing in his path. That effort appears as volume. The result of successfully absorbing that supply appears as rising price. This is harmony. And harmony tells you one critical thing: the move is genuine, the control is real, and the trend is healthy enough to follow. But here is where modern traders must pay the sharpest attention. In today's markets, driven by algorithmic strategies, high-frequency activity and institutional order flow, volume signals have become even more precise and revealing. When you observe a significant volume surge on your chart accompanied by a proportionally meaningful price advance, that is not coincidence. Informed money is moving with purpose and conviction. The effort is producing its rightful result. However, and this is where fortunes are separated from failures, when you witness enormous volume with barely any price progress, something far more important is being revealed. That volume means orders are crossing in massive quantities, but price isn't moving because an equally powerful opposing force is absorbing every single one of them. The effort is being neutralized. The result is being suppressed. A hidden hand is working against the visible move. Once you genuinely internalize this relationship, that price must always justify its volume, and volume must always explain its price, the market transforms entirely. What once appeared as random, chaotic movement becomes a structured, readable conversation between buyers and sellers. You will never watch a candle the same way again, and that clarity is precisely where consistent trading begins. Richard Wyckoff said that price and volume are the only two elements that cannot lie. Learn to read them together, and the market will guide you. When the market moves in unison, the trend is telling you to trust it. There is a moment every trader dreads deeply. Price has been trending beautifully in your favor. Your position is profitable. Everything appears strong. Then suddenly doubt creeps in like a shadow. Is this trend about to reverse? Should you exit now and protect profits? Should you add to your position or step aside completely? That paralysis, that suffocating uncertainty, costs traders more money than actual losing trades ever do. Before you make another emotionally driven exit from a perfectly healthy trend, pause completely. Look beyond the price candles. Look beyond the moving averages and indicator signals crowding your modern screen. Strip everything back to its most fundamental truth. Is the market moving with harmony or without it? That single question answered correctly will eliminate more doubt from your trading than any technical indicator ever manufactured. Because harmony is not a feeling. It is a measurable, observable, verifiable condition present directly on your chart if you know precisely what to look for. In my years of reading the tape, I discovered that healthy trending markets always reveal one unmistakable signature: effort and result moving in complete agreement. This agreement is what I call harmony, and its presence is the market's clearest confirmation that professional, informed money is actively supporting the prevailing direction. Observe the impulse movements within any genuine uptrend. When price advances strongly, volume increases alongside it. The buying effort is meeting its rightful result, higher prices. This is not accidental. Large professional operators are deploying capital aggressively because they have verified that the path of least resistance is upward. Their effort is producing exactly the result they intend. Now observe the corrective movements, the pullbacks within that same uptrend. Price retreats modestly, but crucially, volume contracts significantly during this retreat. This decreasing volume on pullbacks is not weakness. It is actually the most powerful confirmation of underlying strength available to any trader. It reveals that sellers lack genuine conviction. They are not aggressively attacking the trend, they are simply creating temporary, low conviction pauses. In today's modern markets, where algorithmic systems execute thousands of orders per second and institutional desks manage positions across multiple timeframes simultaneously, this harmonic signature remains equally valid and perhaps even more precise. When your volume indicator contracts noticeably during a pullback on a trending stock, cryptocurrency or forex pair, you are witnessing informed money, quietly stepping aside, not positioning against the trend. The professionals are not selling, they are simply not buying momentarily. This distinction is everything. Wide-range bullish candles accompanied by swelling volume on advances, followed by narrow-range candles with shrinking volume on retreats. This rhythmic pattern is the fingerprint of a controlled, institutional-grade trending move deserving of your full confidence and participation. Once you train your eyes to recognize harmonic trending conditions, strong effort producing strong results on impulses, minimal effort producing minimal results on corrections, uncertainty dissolves completely. You stop questioning healthy trends. You hold your position with conviction. You add strategically at pullbacks instead of exiting prematurely. The trend becomes your ally rather than your source of anxiety. And that composure, that disciplined confidence built on genuine market reading is precisely where profitable trading truly lives. Richard Wyckoff said that the trend that advances on strong volume and rests on weak volume is the trend most worthy of your confidence. Follow it without hesitation. When effort and result stop agreeing, the trend is already dying. Picture this moment. A stock you have been watching for weeks is making new highs. Financial headlines are celebrating the move. Social media trading communities are screaming bullish conviction. Every surface-level signal is pointing upward. You are about to commit significant capital, convinced that momentum is unstoppable. Then something happens that no headline will ever warn you about. The trend quietly and visibly begins to die, long before the reversal candle ever appears on your chart, and almost nobody in that celebrating crowd notices. Until it is catastrophically too late. Before you chase another momentum move simply because price is printing new highs or new lows, stop completely. Do not allow the noise of modern markets, the algorithmic price action, the social media euphoria, the talking heads projecting endless continuation to override your most fundamental obligation as a serious trader. You must examine whether the effort being deployed in this market is actually producing proportional results. Because if it isn't, you are not witnessing strength. You are witnessing the final, desperate gasps of a dying trend. Divergence between effort and result is not a minor technical signal. It is the market's most honest confession, spoken in volume, ignored by the crowd. Throughout my career studying price and volume relationships, one pattern revealed itself with remarkable consistency across every market condition. When significant effort produces increasingly disappointing results, the force controlling that trend is exhausting itself. This exhaustion is what I define as divergence. And divergence, when properly identified, is among the most powerful reversal signals available to any serious trader. Consider a rising market making successive new price highs. On the first advance, volume surges powerfully and price responds with a substantial move higher, perfect harmony. But on the second advance to new highs, something shifts. Volume surges again, perhaps even more aggressively, yet price barely extends beyond the previous high. The effort has increased. The result has diminished. That contraction in result relative to effort is divergence speaking its clearest language. What is actually occurring beneath that surface? Professional operators who originally drove the trend upward are now quietly distributing their positions, selling into every enthusiastic buying surge generated by uninformed participants. Each wave of retail buying effort gets absorbed by institutional selling. Price inches higher with enormous struggle because informed money is now working directly against the prevailing direction. The volume you observe is not bullish conviction, it is a transfer of stock from strong, informed hands into weak, uninformed ones. In today's modern trading environment, where retail participation has exploded through commission-free platforms and where algorithmic momentum strategies amplify every price move, divergent signals have become even more critical to master. When Bitcoin surges to new highs on decreasing exchange volume, when a high-momentum technology stock prints new all-time highs with noticeably contracting institutional volume, when a currency pair pushes through resistance with visibly weakening commitment. These are not buying opportunities. They are professional exit points disguised as continuation signals. The greater the divergence, the wider the gap between effort deployed and result achieved, the more powerful and decisive the coming reversal will ultimately be. Once you develop the disciplined habit of measuring effort against result on every significant price move, the market's most dangerous deceptions lose their power over you completely. You will recognize distribution disguised as strength. You will identify exhaustion masked as momentum. You will step aside or position confidently in the opposite direction, precisely when the uninformed crowd is most aggressively committing capital to a trend that professionally informed money has already abandoned. That is not just better trading. That is reading the market the way it was always meant to be read. Richard Wyckoff said that in his book, "When price advances on diminishing volume, the trend is not strengthening, it is surrendering." The wise trader reads this confession and acts accordingly. The market's most powerful move is sometimes made in complete silence. Here is a scenario that has destroyed countless promising trading careers. The market has been falling relentlessly for weeks. Every session prints lower lows. Every recovery attempt collapses immediately. The news cycle is saturated with catastrophic narratives. Experienced traders are publicly declaring further downside inevitable. You stare at your screen convinced that selling pressure is infinite, that no rational argument exists for even considering a long position. The market appears terminally broken, completely beyond recovery. And then almost invisibly, almost mockingly, price begins to rise. Not explosively, not dramatically. just quietly, persistently, effortlessly upward. And you missed the entire reversal because you were watching for the wrong signal entirely. Before you dismiss another low-volume session as meaningless market noise, stop and reconsider everything you believe about what drives price movement. Modern trading education overwhelmingly focuses on aggressive participation, large volume surges, climactic candles, explosive breakouts. These are visible, exciting, emotionally satisfying signals to trade. But this singular focus on high-volume events creates a dangerous blind spot that quietly punishes traders who never learn to look beyond it. The most significant market reversals in history have not always announced themselves with thunderous volume. Many arrived in near complete silence, and that silence was itself the signal, if only you understood precisely what it meant. During my extensive study of tape reading and price behavior, one profound truth consistently emerged that most market participants never fully grasp. The absence of one force is equally as powerful as the aggressive presence of the opposing force. Markets do not require explosive buying to rise. They only require the absence of meaningful selling. This distinction is subtle, but its trading implications are absolutely enormous. Consider a market that has declined substantially over a prolonged period. Sellers have dominated completely, aggressively pushing prices lower session after session, but gradually, almost imperceptibly, something changes. The volume on downward sessions begins contracting noticeably. Bearish candles narrow in range. Price still drifts lower momentarily, but the effort required to push it down is visibly increasing, while the distance achieved keeps decreasing. The sellers are not being defeated by aggressive buyers. They are simply running out of conviction, running out of stock to sell, running out of willing participants to continue the campaign. This withdrawal of selling interest creates a market vacuum. And into that vacuum, even modest buying pressure produces disproportionately large upward price movement. The path of least resistance has silently shifted, not because bulls arrived powerfully, but because bears quietly departed. In today's modern markets, this phenomenon appears with remarkable regularity and clarity. After aggressive sell-offs in cryptocurrency markets, you will observe sessions where price barely moves despite minimal volume, sellers exhausted, buyers cautious but present. In equity markets following institutional distribution phases, low-volume consolidation periods near lows frequently precede powerful reversals as selling supply becomes completely absorbed. In forex markets, currency pairs drifting lower on progressively contracting volume signal that bearish momentum is evaporating, not accelerating. The Waves Wave tool, measuring cumulative volume across complete price waves, reveals this condition with particular clarity in modern charting platforms. When downward waves show progressively shrinking volume while price makes marginal new lows, the bearish wave is dying through exhaustion rather than defeat. That subtle but consistent pattern of declining effort on declining waves is the earliest, most reliable warning that the reversal is already quietly beginning beneath the surface. Similarly, watch for identical conditions at market ceilings. Narrow-range candles at highs with minimal volume do not represent healthy bullish continuation. They represent buyers who have lost genuine interest in paying higher prices. That quiet disappearance of buying enthusiasm, that low-volume ceiling behavior, is the professional trader's signal that demand has been fully saturated and that any modest selling pressure introduced now will move price dramatically lower with minimal resistance encountered. Once this understanding becomes permanently embedded in your market reading approach, you will never again dismiss a quiet, low-volume session as uninformative or tradable. Every contraction in volume near a significant market extreme becomes a conversation worth hearing. Every session where price struggles to move despite minimal opposing pressure becomes a potential reversal signal worth investigating thoroughly. The market does not always announce its greatest turns with dramatic climactic volume. Sometimes it simply grows quiet, withdraws its dominant force, and allows gravity to do the rest. Read that silence correctly, and you will consistently position yourself at precisely the moment when the crowd is most confused, most hesitant, and most completely unprepared for what comes next. Richard Wyckoff said that a market that cannot fall on bad news or rise on good news is a market already controlled by the opposing force. The silence itself is the signal. One dimension of truth is never enough. The market demands you see the complete picture. Here is the silent killer of technically educated traders. They study volume. They understand its importance theoretically. They observe a single candle showing strong volume accompanying a price advance and immediately conclude. Harmony confirmed, trend valid, position justified. They commit capital confidently based on that singular observation. Then the market reverses violently against them. They sit confused, frustrated, questioning the entire framework. Volume was present. Price moved. Everything appeared correct. Yet the trade failed catastrophically. The methodology was not wrong. Their application of it was dangerously incomplete. Before you make another trading decision based on a single volume observation from a single market dimension, stop entirely. Understand something critically important about how this law actually functions in real market conditions. The law of effort and result is not a one-dimensional tool to be applied casually to individual candles in isolation. It is a multi-layered analytical framework that demands simultaneous evaluation across 5 distinct dimensions before any meaningful conclusion about market condition can be honestly drawn. Traders who apply it superficially will occasionally succeed by accident. Traders who apply it comprehensively will succeed by design, consistently, repeatedly, and with genuine confidence, built on complete market understanding rather than selective observation. Throughout my career, reading the tape across every conceivable market condition, one discipline separated consistently profitable operators from perpetually struggling ones, the ability to evaluate effort against result simultaneously across multiple analytical dimensions, building a complete and honest picture of who genuinely controls the market at any given moment. The first dimension is the individual candle. Here you examine whether the price range achieved is proportional to the volume traded within that single bar. Wide-range candles deserve high volume. Narrow-range candles should carry minimal volume. Any contradiction between range and volume within a single candle is your first warning signal worth investigating further. The second dimension examines subsequent price displacement. A high-volume candle means nothing in isolation. What matters enormously is the directional movement that follows it. Does price continue in the candle's direction, confirming genuine intent? Or does price reverse immediately, suggesting that volume was actually absorbed by opposing professional interest? This subsequent behavior transforms a single candle observation into a meaningful market statement. The third dimension analyzes complete trend movements, comparing successive impulse waves against successive corrective waves across the broader trend structure. Are impulses growing stronger with increasing volume while corrections remain shallow with contracting volume? Or are impulses weakening progressively while corrections deepen with growing participation? This comparative wave analysis reveals trend health or deterioration with remarkable clarity. The fourth dimension employs wave volume analysis, measuring cumulative volume across complete upward and downward price waves separately. In modern trading platforms, this is beautifully visualized through the Waze wave indicator, which accumulates total volume traded throughout each directional wave and displays it as a single readable value. When upward waves consistently carry greater cumulative volume than downward waves, buying pressure demonstrably dominates. When downward waves begin accumulating greater volume than upward waves, regardless of what price alone suggests, Selling pressure is quietly gaining institutional control beneath the surface. The fifth and perhaps most decisive dimension evaluates effort and results specifically at critical breakout levels. This is where modern traders make their most costly errors. When price approaches a significant resistance or support level with strong volume and achieves an effective, sustained break, effort and result are in harmony and the breakout deserves genuine confidence. But when price attacks that same level with enormous volume, yet immediately reverses back inside, that entire volume was not supporting the breakout. Every contract of it was being absorbed and traded against the directional move by informed professional operators positioned on the opposite side. The breakout was never genuine. The volume was the trap, not the confirmation. In today's electronically driven markets, where momentum algorithms pile aggressively into every apparent breakout, and where retail participation amplifies false moves with extraordinary speed, this fifth dimension has become the single most important filter separating genuine institutional breakouts from professionally engineered liquidity traps designed specifically to harvest stop orders and fuel moves in the opposite direction. Once you commit to evaluating this law across all 5 dimensions simultaneously, candle behavior, subsequent displacement, trend movement comparison, wave volume analysis and breakout level assessment, something transformative occurs in your market reading capability. Individual signals that once appeared contradictory suddenly align into coherent, comprehensive market narratives. Apparent breakouts reveal themselves as sophisticated traps before you commit capital. Genuine trend continuations become unmistakably obvious before the crowd recognizes them. Reversals announce themselves across multiple dimensions simultaneously, giving you layered confirmation that no single dimension analysis could ever independently provide. The market is never speaking in a single voice. It speaks simultaneously across every time frame, every candle, every wave, and every critical level all at once. Your obligation as a serious, disciplined trader is not to listen selectively. It is to hear everything. Words of Richard Wyckoff: no single signal, however powerful in isolation, tells the complete story of the market. Combine every dimension of effort and result into one unified reading, and the market's true intentions become impossible to misread. The market has always been speaking. The question is whether you finally choose to listen. Every trader who has ever blown an account, missed a perfect reversal, chased a dying trend, or exited a healthy position prematurely shares one common experience. In that painful moment of loss, when the market moved decisively against their position, the signals were already there. Printed clearly on the chart, visible in the volume, readable in the relationship between effort and result. The market never deceived them. They simply never learned its language well enough to hear what it was saying. That realization, that the answers were always present and simply unread, is simultaneously the most humbling and the most empowering truth any serious trader can ever confront. Before you return to your charts tomorrow morning, before you execute another position based purely on price pattern recognition or indicator signals, pause and absorb completely what this law demands of you. It demands nothing complicated. It demands nothing requiring expensive software or algorithmic sophistication. It demands only one discipline: that you never again evaluate price movement without simultaneously evaluating the volume effort that produced it. That single discipline, applied consistently and honestly, will fundamentally transform every trading decision you make from this moment forward. We have now traveled through the complete landscape of this magnificent law together. We began by establishing the foundation that volume is effort and price is result, and that no meaningful market movement can be honestly evaluated without measuring both elements simultaneously. We then discovered that harmony between effort and result is the market's clearest confirmation of genuine trend health, strong volume on impulses, contracting volume on corrections, revealing the rhythmic fingerprint of informed institutional participation driving price with purposeful conviction. We then confronted the most critical warning signal available to any modern trader: divergence between effort and result. When enormous volume produces diminishing price progress, when successive new highs or lows are achieved with visibly decreasing commitment, the trend is not strengthening. It is confessing its own exhaustion. Professional money is already positioned against the prevailing direction, while the uninformed crowd celebrates continuation that will never arrive. We then uncovered perhaps the most sophisticated understanding this law offers: that lack of interest is itself a market force. Reversals do not always announce themselves through climactic volume events. Sometimes the most powerful signal is near complete silence: sellers withdrawing at market floors, buyers disappearing at market ceilings, the dominant force simply exhausting itself into irrelevance, while even modest opposing pressure produces dramatic price movement in the new direction of least resistance. Finally, we recognize that this law must be applied across multiple dimensions simultaneously, on individual candles, across subsequent price displacement, through complete trend movements, within wave analysis, and at critical breakout levels, building a comprehensive, layered reading of market condition that no single indicator or price pattern could ever independently provide. In today's modern markets, faster, noisier, more algorithmically driven, and more emotionally charged than anything witnessed in previous generations, the law of effort and result has not weakened. It has become more essential, more precise, and more revealing than ever before. Because beneath every algorithmic strategy, every high-frequency transaction, every institutional order flow decision, the same fundamental truth persists unchanged across every market, every time frame, and every instrument traded anywhere on Earth. Effort must produce proportional result. When it does, trust the trend completely. When it doesn't, prepare for the reversal with absolute conviction. The market has been speaking this language since the very first transaction was ever recorded on a trading floor. It spoke it clearly in my time. It speaks it clearly in yours. The only variable, the only element that has ever determined whether a trader profits or perishes from this knowledge is whether they develop the patience, the discipline, and the genuine commitment to sit quietly before their charts and truly listen. Now you possess the framework. Now you understand the language. The market is speaking to you every single session, through every volume surge, every quiet contraction, every harmonic impulse, and every divergent warning. The only question that remains is beautifully simple. Are you finally ready to listen? Richard Wyckoff says that the tape tells all, to those patient and disciplined enough to read it without prejudice, without emotion, and without the interference of opinion. Master volume and price together, and the market will reveal its intentions to you before it reveals them to anyone else.